Hey, everybody. Welcome to another episode of The Remote Real Estate Investor. I'm Michael Albaum, and today I'm joined by my co-host,
Tom Schneider.
And with us today, we have a repeat, very special guest, Paul Moore of Wellings Capital. And Paul is going to be talking to us today about the transition going from single family into multifamily and then into massive multifamily syndication. So let's get into it. Paul Moore, thank you so much again for coming back on, man. Really appreciate you taking the time.
Yeah, it's great to be here, Michael. Thank you.
So, Paul, what I wanted to chat with you about today is multifamily, because I know that you are a big player in the space. And so maybe you can just start off by sharing with folks, what are some of the benefits of multifamily versus single family that, in your opinion, you've seen?
Yeah, so just for a quick history, I flipped single family homes for years. You know, we did dozens and dozens and dozens of homes. And we also did waterfront lots. I did some ground up single family. And I wasn't sure how to get into the commercial real estate realm. And actually, a friend of mine and I found this huge glut or this shortage, actually. What am I saying? A glut? No, an anti-glut in housing in North Dakota for the oil boom that was going on there during the Bakken years of like 2010 and on. And so we built a multifamily facility, sort of a quasi hotel, and then we built another one next door. Then we ended up building a Hyatt hotel and found out that, man, I really like commercial multifamily. I like having all these doors under one roof. I like one parking lot. I like one, place where all the toilets are and everything. So we jumped into multifamily and we really never looked back from that point on. And so that's how I got into it. Multifamily is interesting because the government helped cause a huge supply and demand imbalance in multifamily. So in the mid 1990s, the government, in its great wisdom, decided that everybody who could fog a mirror should own a house. And so they actually passed laws and they forced those laws down on the bankers. There's different opinions on how this really happened, but basically saying, like starting this massive subprime mortgage boom. And basically they said, look, you don't have to have a good income. You don't even have to tell us your income. You can just do stated income, or you can even do no doc. And you guys remember that. And so lots and lots and lots of people were able to buy a home. I have a friend who was making about $40,000 or $45,000 a year. He had a house and he bought I think it was a $500,000 second home in the town he grew up in. It was actually like a little castle. It was in this, this town that was actually in decline in West Virginia. And he bought that as a second home. And, he didn't even have a really good plan. It was years and years before Airbnb. And so he lost it back to the bank. And a lot of people lost their homes. But what happened is home ownership went up from its historical norm of about 63% to 69.2% by 2005. And so from 95 to 05, it went up a whole lot. And so single family home ownership was in, multifamily was not so much. And then, of course, we had the crash the cracks that started in 06 and 07, and then the crash that happened from really 07 to 10. And there was a lot of people who lost their homes and a lot of people who said, you know what, the American dream of having a home, having my own house is not such a great dream, as they watched some of their parents and their friends and themselves lose a home and lose all this massive amount of equity. I know a guy named Rod Cleef, who you guys might have heard of in Florida. He had his net worth went up by, I think, $30 million in Florida in single family homes between like 05 and 07. And then it dropped like $50 million after that. And he lost all his single family and his multifamily because they were tied together on loans, that were kind of cross collateralized. But at any rate, single family home ownership dropped back down to around 63%. And every 1% drop from 69.2 to 63-ish was represent 1 million people coming into multifamily. But they came in at a time when there wasn't a lot of multifamily being built, like 07 to 09, 10, 11. And so there became this pretty significant supply and demand imbalance. And the 4 types of people who are coming in, and at the time, especially right after the Great Recession, but even to now are coming in. Number 1, baby boomers, people my age. It's the smallest number of multifamily tenants, but it's actually the fastest growing. And statistics say when someone goes from a single family home that they own to multifamily, they typically never go back to owning their own home. Second group is millennials. Now, millennials in general, not you guys, but a lot of people, a lot of them don't see the point in tying themselves down to a 30-year contract on a seemingly overpriced home when they might have new opportunities, new friends, new jobs, something across town or across America or around the world next year. And a lot of them historically have had a lot of debt. And with the new rules that came in after the crash, a little over a decade ago, it's harder to qualify for a loan. And so millennials on average rent more than buying compared to other generations. You've also got Gen Z. It's hard to say where they're going to land, but at this time, Gen Z, which is about as large as the millennial group at 77 to 82 million strong in America, they are also renters. And then the 4th group is immigrants. Now, people who weren't born in the U.S. On average rent more often and rent for longer than people born in the U.S. And so the question is, are we going to end up trending more toward Detroit, where there's over 70% home ownership, or more toward Dallas, where home ownership is down around 50%? It's hard to say, but my money's on Dallas.
It's funny that inverse relationship of in Europe. There's some studies out where you have countries, some Scandinavian countries where maybe home ownership is left, but the economy is a lot more dynamic versus country where home ownership is very high, Spain and Greece, and usually the economy is a little sluggish. And I think a lot of it has to do with what you're talking about, where you have that mobility. You aren't necessarily locked in here and you can, move around. I think that's part of it. I love that story related to The Big Short, talking about the run of the economy. I'd love to hear how your business evolved throughout that. So you said you initially were in single family. Was that in this run up time, or had you already transitioned? I'd love to hear kind of the confluence of you through that whole, through that market dynamic change. Yeah,
I'd like to say I thought through it. And made some intelligent decisions based on
your crystal ball.
It just didn't work for me. But no, I had I sold a company to a publicly traded firm when I was 33 in Detroit, and that was in 1997. At 34, I found myself pretty bored. And so I started flipping single family homes in 2000. And we did that. And then we built some ground up homes, and then we did a small subdivision. And like I said, I got into land and lots for a while, but I also set up a website that sold leads to realtors, and I still have that running in the background 17 years later, and it's still going pretty well. That's a regional thing right here in the certain part of Virginia here. But at any rate, during that time, I didn't know how to get into commercial. I didn't know, how would I get into large scale multifamily? I didn't have $10 million, and I didn't know who to trust, where to start. Syndication was a thing we didn't really know much about. I mean, we knew that there was a thing called syndication where you can pull together a few active and then a whole bunch of passive investors. But we really didn't know how to do that. And we were sort of thrown into that when we started building much larger assets, than we had the money for ourselves. And that was in 2011. And, when single family and small multifamily around the country was in the tank, we found that the opportunity in the Bakken region of North Dakota with the oil boom made a lot of sense. And so we kind of fell into that, Tom. I mean, we had a failed oil and gas investment in North Dakota, but that's how we learned about the housing shortage there when we drove up there and saw people sleeping in their pickup trucks along the side of the road, in rest stops, and in Walmart parking lots.
There's so many interesting, successful businesses like that where you went to the gold mine, searching for gold, the analogy, like oil. But then you found the money was in the picks and the axes. And in that analogy, that would be the actual housing for it. So
that's right.
Man, that's such a common successful entrepreneur story of just kind of having eyes wide open and, pivoting as it makes sense.
Yeah. So which is more exciting, hitting oil or building a multifamily property to house the oil workers? Now, seriously, there's this thing called I'm working on a book. I'm just kind of in the early stages, The Joys of Boring Investing, or possibly The Boring Investor. Boring investing is powerful. I don't know if you guys have heard of the coffee house investor, but it's basically saying this: look, why should we actively trade stocks and Bitcoin and all these things that are so exciting? Sure, throw a little bit into that, but why are we spending our life's energy when we could be hanging out with our families or friends or having a better marriage or whatever those things could be, and make more money in ETFs? And so the thought there, and I'm not a stock guy, but the similar thing in real estate is this: would you rather let's say you're a professional, let's say you're a doctor, a dentist, a lawyer, an IT person, you're making hundreds of thousands of dollars a year, and you're trying to flip a house on the side. It doesn't always make as much sense to do that when you can have somebody else do it for you. And so I think companies like Roofstock and my company, we provide opportunities for people to get involved passively, still get the profit, still get the appreciation of real estate, but at the same time, they don't have to give every waking moment of their free time to this. And that's one thing I love about it. And that's sort of similar to what you said, Tom. And I mean, you can either go out there and try to be out in the caves and, in 1849, trying to mine for gold, or you can just sit comfortably in your hardware store and sell all the equipment to them, or you could be Amazon and ship them the equipment. Wait, what? Wait a minute. Anyway,
I love that concept of a book, just kind of going into the boringness as like the winning strategy. And I mean, I just in talking with friends, I think a lot of it is FOMO. It's a lot of it the psychology, Maybe you have of some guy who got in at Bitcoin really early, and it's like, oh, maybe I should do that. But it's like having a kind of a balanced approach at looking at the variability of it, right? The beta versus some boring ETF strategy.
I agree with you both, because I think it's not sexy to talk about at dinner parties that you invested your money in something and it's just sitting there earning you a great return. Like, everybody wants to hear the big win stories where you swung for the fences and knocked it out of the park, or it didn't go so well. I mean, that's the stuff people want to talk about. But I couldn't agree more. The passive stuff is really great. And Paul, I was hoping to kind of get your take on this about how folks, you touched on it a little bit about syndication, but I think so many folks can't fathom investing in commercial real estate, multifamily real estate. And for those of you that don't know, that's 5 units and up. Residential is 4 units and below. So how could people start investing in 100 units, 200 units, 500 units? What's the path to get there? And then we'll come back to it and talk about how people can go from 4 to 5.
Yeah, that's great. So if they want to invest in larger, let's say, so I have some money in an IRA and I can't invest in my own company because it's an IRA and it has to be, like arm's length. And so I look for other opportunities there. And I'm looking for something really passive and really boring. Now, recently, my friend told me how he was getting a 60% return on setting up this amazing log cabin Airbnb in Gatlinburg, Tennessee. And I was like, wait, 60% annual return? He's like, yeah, I bought $1 million house. I financed 900,000 of it. So I have 100,000 in it and I'm getting 60 to 70,000 free cash flow a year. And he's actually done this over and over and he's helping other people do it now. So I got really excited about this in June. And then I thought about it through July and I thought about it through August. And I thought, wait a minute, you know what? That would be so exciting because I love Gatlinburg. That would be exciting and that would make a lot of money, but that would be another thing to think about. That's going to be another thing I have to worry about. That's going to be some call, from, even if there's a third party manager, I'm going to get calls, about some toilet overflowing or some insurance or something. And I'm making pretty good money in our company. And I don't want to have to think about that. And that's my passion, to tell people, to be a boring investor and to do it through like syndication, for example. Do any of us really think we're going to go out and find a 2 or 3 or 500 unit apartment and somehow find a deal that nobody who's given their whole life to it, these hundreds and hundreds of companies who are pursuing these night and day with a team of people? Do we really think we're going to find a deal? It's probably not going to happen in the real estate realm and at that size. And so why not align yourself with the people who know how to find those deals and just invest in their deals? And so that's what I recommend. I talk about, my new book has a section, like 50 pages of 7 paths to get into large scale commercial real estate. But the path I'm recommending for this podcast, for this discussion, would definitely be invest passively with somebody who is an expert.
So this is probably a common question. I think this all sounds great, but how do you build trust with someone where you're going to give them a bunch of your money? How do you cross that chasm, cross that bridge to getting comfortable, especially for doing it for the very first time, putting funds into a syndication?
So Tom, before I answer that, I just want to make sure, are you saying how do I build trust as a syndicator to get people to give me money, or vice versa? How do I trust the person?
Yeah, vice versa. I'm evaluating, sure, the log cabins in Gatlinburg sounds super fun, but passive income, let's do that. Okay. How do I sort of vet a potential syndication to put funds into? What would your thoughts around that? Yeah,
so a couple of things I would do. There's a book called The Hands-Off Investor by Brian Burke. And this book is, it's a wonderful book by a guy who is a syndication expert. He's done thousands and thousands of apartment units, and it's published by Bigger Pockets Publishing. So I'd highly recommend The Hands-Off Investor. It's about a 300-page guide which will tell you how to evaluate a syndicator before you invest. Secondly, I would go to the Real Estate Crowdfunding Review. And it's not just for crowdfunding, it's for syndication in general. And it gives a tremendous amount of information and education about how to vet operators, fund managers, syndicators, etc. And it basically helps people figure out, what they need to know before they invest. There's a lot of other investors on there, and they give very honest reviews. And there's no syndicators or fund managers allowed in their group at all. And so I could never see what people are saying about me there. So they probably feel a lot more willing to be honest, good and bad.
I love how self-serving these episodes are. This is incredible. Yeah, I love it. I have my Amazon queue, the Hands-Off Investor, and that link to that site up right now.
Yeah, you know what? I didn't really answer your question that well. Those are 2 resources. I'll just tell you real quick. I would actually see how much skin they have in the game, how long their track record is, do they have a cohesive team, how do they treat their staff, how do they talk about their other investors, what do other investors that they refer but also that you find yourself, what do they say about them? What kind of risks are they taking? What kind of cap rate are they assuming on exit? Which, in other words, how much do they assume that the market will go up or down on exit? What kind of occupancy assumptions are they making? What kind of rate increases, rental rate increases, and cost increases are they assuming? There's a lot to know. And that's why it's so important to lean on things like, other people's reviews, which you get, especially at that real estate crowdfunding review site.
Paul, I agree with everything you just said. taking it a step further and a layer deeper, if someone is brand new to the multifamily space and brand new to syndications, how can someone know if the cap rate that's being projected on the exit is reasonable, or the vacancy that they're projecting is reasonable, or their costs are reasonable?
That's really tough. I was just talking about this to an investor about an hour ago, and he was asking me, he said, if I invest with you, what kind of quarterly reporting will I get? And I said, well, the problem is you're going to have to really trust us, honestly, and you're going to have to trust the people we invest with, because the quarterly reporting it might make you feel good to see a big page of numbers. But first of all, if there's one mistake in their Excel spreadsheet, it can throw off the whole sheet. You know how that works.
It's all garbage, yeah.
It's all garbage. But also, you won't really understand it. I mean, you won't really, really know. And so this is, again, going back to trust. And this is why I like the educational model, which is what you guys do so well. You're educating your audience. You're telling them about, the different reasons people should look at a real estate investment with Roofstock, and other people on podcasts are telling you about theirs. That's why I think education is so important, and building a loyal group of people over many, many years. There's a lot of newbies who are doing this now, and there's some of them say stuff like, hey, the real estate market, it'll never go down again. People always need a place to live. That's not true. And history tells us it's not true. And so my money's, again, on people that have been around, like Buffett, 91 years. And he has some things to say. Even though he's not a real estate investor, he has some really, really important principles for real estate investors. And I love to study his stuff.
Yeah, that's such a good point. I've been to several multifamily workshops and syndication workshops, and they're talking about how, it's really important to evaluate not just the deal, but just to your point, the sponsors. Who's putting this deal together? Why is it that they're asking for money? What does their track record look like? So I think if the numbers, you can't read the numbers, or you can't tell the story between the numbers, look to the folks who are behind the numbers to get a good understanding of how that deal is going to perform.
Yeah, that's true.
So wondering if we can shift gears here a little bit, Paul, and if you could share with us a little bit on what you've seen folks do really well, or maybe you personally, how you went from single family into small commercial multifamily. Because I think that there's this chasm, Tom, to use your word, that people can't make this mental shift, that there's this commercial real estate in the multifamily space is so different than residential or than single family. So what have you seen folks be successful to make that leap?
Yeah, I think it's just actually doing it. I mean, getting some education. There's a lot of great podcasts out there these days. There's books, there's mentoring, there's coaching. Of the paths, that I mentioned earlier, I really highly recommend, getting paid coaching or even unpaid mentoring and learning from somebody who's been before you. One thing, I hate to sound like rude, but I'll be on a Bigger Pockets forum answering a question. And if somebody says I'm trying to make a decision on how much to offer on the single family house, great. That's great. That's no problem. I understand that. But when somebody's on there saying, I'm trying to buy a $2 or $3 million mobile home park or self-storage facility or, even a 20-unit apartment, and they don't even know really basic stuff like what does cap rate mean or whatever, I'm like, don't do this.
What are you doing?
You're risking your family's money and your friends' money, and it's almost sure to be a failure. I mean, the big money in commercial real estate is buying from a mom and pop operator and improving it. And we've seen people double or triple. I'm doing a case study this week with somebody who was able to quadruple their investors their group of investors' equity, quadruple it in 2 years. It was from buying a $10 million self-storage facility from a total mom and pop operator who didn't know what he was doing. And so don't be one of those. And the way to not be one of those is go get a paid coach or potentially an unpaid or semi-paid mentorship with somebody who's way ahead of you. And then, like I said, books, podcasts, etc. is really helpful.
Yeah, that's such a great tip. I do a lot of coaching inside the Roofstock Academy, and I'll get folks in there sometimes and say, "Oh, I want to go big for my first one." And I said, "Well, why?" "Well, because I want to do this, that, and the other thing." And I said, "Look, I can almost guarantee you're going to make mistakes. You're going to learn lessons. And would you rather learn those lessons on a big property with a lot of risk, or on a smaller property with a whole lot less risk?" And 90% of the time it's, so let's go learn with training wheels, and then we can go ride our bikes.
Yeah, I agree. It's so true. And I wish I'd have known that years ago. I mean, I made so many mistakes like this. And, I love what the first Nobel Peace Prize winner, Paul Samuelson, in economics from the US, he said, investing should be boring. It should be like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. And it's
great.
So people want to, and part of the excitement is going big. Go big or go home, right? But life doesn't work that way very often. And when it does, it's such an exception that, they write books and tell stories about people like that. I mean, people think, Jeff Bezos was an overnight success. He has massive pain and failure in his background before he got to where he got,
Yeah, it's so true. People only talk about the highlight reels. No one talks about the other 99% that fail or don't make it, or that, go home crying.
Right.
Yeah.
Yeah.
Curious.
It's true.
Curious, Paul, what is one of, a couple of the big mistakes that you see newer investors make as they make the transition to multifamily?
That's good. One would be just assuming that you can increase rents like 6% a year every year, but costs are only going to go up 2%. Doesn't make a ton of sense. Although it could happen, it could happen if you can find some efficiencies and things like that. Another one is not aligning with a great property management team. I think finding a property manager is critical. I know a guy who's a medical professional. I met him recently, and he had 42 units, and he was managing it himself, trying to run his medical practice and managing 42 units. He's like, well, the cash flow would be destroyed if I got a property manager. And I'm like, yeah, but your life's destroyed now, and he was telling me how a tenant had just moved into a place on Monday and on Wednesday set it on fire. I mean, that was like 3 days before I met him. And I'm like, okay, so if you just owned that and you weren't the property manager, you'd still have a ton of hassle here. But as the property manager and the owner and asset manager, you've got like 10 times more. And so I think that is one big mistake people make, assuming they can do it on the side, and assuming it won't be that much hassle, and assuming that there won't be any vacancy, things like that.
Pennywise, pound foolish. I guess Pennywise, sanity foolish.
Yeah, right.
Yeah.
For sure.
One big one that I see is when folks start to bridge this gap, and it could even be in residential multifamily, but they'll look at a single family house that rents for $1,000 a month, and they'll look at a duplex that rents for $1,000 a month gross, each side for $500 a month, and they'll evaluate those two properties as the same. And I would say that they're not, because the folks renting that single family are going to be a different tenant class than the folks renting that the duplexes. So you've got to go beyond the numbers, and don't live in the spreadsheets, because it'll come back to bite you in the keister.
Yeah, sure will. That's a great point. Appreciate that, Michael. That's good.
Paul, I think we're kind of at an interesting economic point right now where we've had this wild run up on appreciation, and maybe it will continue, maybe it won't. I'd love to hear kind of your crystal ball thoughts around the market, rent, prices, just kind of a general musing on what to look towards and coming up in end of 2021 and into 2022.
Yeah, well, I was sitting in an airport, in a tiny little airport in Belize City, going to the Real Estate Guys annual conference in June, and I was sitting next to a well-dressed guy, and I started a conversation with him. It turned out it was Doug Duncan, who is the chief economist for Fannie Mae. And amazing. I was like, well, okay, what do you really think about inflation? And he's like, I really think the same thing I'm saying publicly. I think it'll be in the fives this year, and it'll be like 3.8% next year. I'm like, why do you think it'd be so low at 3.8? Because I said they just injected 30% of the cash that's ever been created in the U.S. It has been created in the last 17 months. So why won't inflation just go through the roof? And he explained that it's not only the amount of cash, it's the velocity of spending. And he said he thinks there's going to be a lot of velocity this year, kind of in this post, like the year after 2020, where COVID was just reigning and ruling over all vacations and everything else. But he thinks there's going to be a big spending spree this year. And of course, we're seeing that. Tons of shortages. I mean, go try to buy a four-wheeler or a four-wheeler trailer right now. You can tell I tried. And it's really hard to find anything, or try to find a car, with the chip crisis. But it's the same in real estate. And Doug Duncan went on to explain, he said, I think the shortage in the real estate market is real. He said, I started sounding a siren in 2014 saying, 7 years ago, that there was this growing supply and demand imbalance, which is sort of what I was talking about earlier, that includes multifamily and single family. And he said that that imbalance is going to take years to catch up. And so it really does seem like the price inflation in, rents and in single family home prices and apartment prices, it seems like it's real and it is justified. And it seems to me that without some huge exogenous shock to the economy, which, we found out we could have, of course, with COVID and other things, aside from that, which is kind of a black swan issue, it seems like the cap rates are going to continue to stay compressed. Returns are going to continue to stay low. It's going to be hard to find single family or small multifamily that cash flows, and people are going to be relying on appreciation. But that's what we've been talking about earlier. That's really risky. Do we want to take risks like that? Well, I'd say this. Align yourself with people who have decades of experience if you're going to. Because right now, if you're just coming in near what could be the top of the market, where the margins are razor thin, if existent at all, and if there's a shock or if there's a downturn, you could get in a lot of trouble getting a 97% loan, and then the value drops by 20 or 30%. I think it's a very risky time to get in, even though what I said a minute ago, it seems like the prices are justified according to Doug Duncan's analysis, which made a lot of sense.
Thank you for that. I feel very optimistic about, in hearing that, and that makes a lot of sense. How does that translate into, your strategy in going into the next year? Is it, kind of cautiously continuing to deploy capital into the space, or I know there's a lot of other strategies, perhaps, new builds or build to rent, new development. Yeah, I'd love to hear your thoughts on that, on translating that information into action.
Yeah. So Tom, Warren Buffett, it sounds like I'm going to go on a bunny trail here, and I am. No, but Warren Buffett, seriously, he hated tech stocks, and he was famous for hating it. But when Steve Jobs died, I think it was 2013 or so, Apple just was really, really stagnant, and he saw his grandkids, how they were addicted to all these Apple products. He saw the consumer behavior among a lot of, Apple people, that they just couldn't wait to get the next thing, that they were basically addicted and chained to Apple. And he said, look, Apple's like in the $20 per share range. And so he started quietly buying it, and he became the largest, to my knowledge, the largest shareholder outside of Apple in Apple stock. And he did it because he saw intrinsic value. And that's where I'm going here. We need to find, I think at this point in the cycle, with this much uncertainty, we need to find intrinsic value. And by the way, Buffett made massive, massive profits for Berkshire Hathaway by his bet on Apple as it went up through the roof after that. And because people saw he saw something that people couldn't see before that. This is kind of crazy quote. Michelangelo said, I saw the angel in the piece of marble, and I chipped away all the other stuff to get the angel, to free the angel. And so the point of that is there's intrinsic value in certain real estate. We've got to find that. I told you the story about the guy I invested heavily with 2 years ago who bought a $10 million self-storage, and now he's quadrupled our equity in it because he saw intrinsic value. He saw stuff others didn't see. The guy in Gatlinburg I told you about, he has a way of unlocking intrinsic value in these cabins to maximize the rental value. I know a guy in Minneapolis, he buys single family homes and like for $400,000, but they only cash flow $1,500 a month to a single family renter. I'm like, how are you making that work? He said, I furnish them and I rent them to students, 2 beds per bedroom for $500 or $700 per bed. And the cash flow is massive because he's able to rent it to 8 students at $600 a bed. That's $4,800 on a $400,000 home. He found intrinsic value. And that's what happens when we buy from a mom and pop. They don't have the knowledge, the desire, or the resources to maximize the income and maximize the value of these commercial or residential assets. And so by buying from a mom and pop, by seeing the intrinsic value, we have a chance to beat whatever happens in the realm of the market, the economy, rents, all that stuff. We can beat it. Even if interest rates go way up from where they are to 5, 6, 7 range, which I doubt they will, by the way. But even if they did, a strategy like this can outfox that. And so I would just say this: look for intrinsic value. Intrinsic value being the value that's hidden from the eye is what I meant.
Yeah. I love chatting with you, Paul, because every time self-doubt starts to creep in on this redevelopment project I'm working on, it's taken longer. It's become more expensive than I initially anticipated. But I hear things like this and I'm like, yes, I'm doing the right thing. This is the right call. And so it's exciting to hear, and it's definitely refreshing to hear. And something that I talk a lot about to investors that I speak with is, hey, everybody can see the same set of facts, but it's those who have can look through things at a different lens or through a different angle that you'll see something different and allows you to see and perform where others can't.
Oh, that's great, man. Thanks for saying that, Michael. And I'm glad to hear about your project. I'd love to hear more about it.
Yeah, absolutely. Absolutely. Tom, any final thoughts for Paul before we let him go?
No, this is I love all the Oracle from Omaha references, the Warren Buffett references, and I love these conversations. Yeah, thank you so much for joining.
Yeah, you bet. Well, I'm actually working on a book called Warren Buffett's Rules for Real Estate Investors, and I'm really excited about it because we're taking two friends of mine and me are taking his principles and applying them to real estate. So it's really fun.
When is that coming out, Paul?
Well, I've got a couple publishers talking about publishing it. We had it about, I think, 75% done a year ago, and then I just completely stalled on it. And so I just reopened all those Google Docs yesterday, and I'm hoping to get it done by the end of the year and come out maybe late 2022.
Awesome. Well, we'll definitely have to have you back on to talk about it because that sounds very interesting.
Thanks. I'd love to do that, man. It's great to be on here.
And for folks that are interested in learning more about what you do with syndications and learning more about you, where should they go? How can they get a hold of you?
Yeah, like I said earlier, I had a hard time figuring out how to get into commercial real estate. And so I've written a guide for people who want to get in. It's actually a quite simple 5-day little course. They can get that at wellingscapital.com/resources. That's WELLINGS, wellingscapital.com/resources.
Awesome. And that's a free download for folks.
Right.
Fantastic. Well, Paul, always a pleasure to have you on. Thank you again for spending the time with us. Really appreciate it. Really insightful, and definitely look forward to continuing the conversation.
You bet, guys. Thanks so much.
Talk to you soon.
Thanks, Paul.
Alrighty, everybody. That was our episode. A big thank you to Paul for coming on again. Always a pleasure to have you, and definitely looking forward to having you back on and talking about your book. Paul's a wealth of knowledge. Feel free to go back and listen to that episode again. As always, if you like the episode, please feel free to leave us a rating or review, whatever this is to your podcast. And we'd love to hear your ideas about future episode topics.
Happy investing.